Hello, I'm Suzanne Briggs. I'm a partner in our private client team here at Blick Rothenberg. Today I am joined by Sarah Wilson-Nolan from our corporate tax team and Jamie Ashby from our accounts and audit team. We're here today to talk about family investment companies from a corporate tax and accounting perspective. So Jamie, we are seeing a lot of interest in family investment companies at the moment. Can you explain what a family investment company is?
Yeah, absolutely. Yeah. So a family investment company is a corporate entity that is registered with the Companies House if it's incorporated in the UK. And what it is essentially used for, it's a vehicle for holding long-term or different types of asset classes, either for generating ongoing income or as a way to pass wealth down through the generations.
So a family investment company is a corporate vehicle. What are its annual filing obligations?
Essentially, the filing requirements for a corporate entity, for a family investment company, is a set of annual financial statements that are filed with the Companies House 9 months after the annual accounting period date. Alongside that, the company is also required to file an annual corporation tax return, which analyses the taxable profits of the company, which is based off of the financial statements. That is due for filing 12 months after the annual accounting period.
And are there additional obligations with Companies House as well?
For a Companies House, you do also have annual obligations in terms of an annual confirmation statement, which confirms the ultimate beneficial owners of the company. That's a statutory filing requirement. Alongside that, the company and the directors are legally obligated to maintain proper and accurate records. And those records are the ones that feed into the financial statements themselves. And it's imperative that those are kept to a very good order because perhaps one of the nuances with a family investment company is that the taxable profits aren't always the same as the accounting profits. So there's a key differentiation there, which is very important to make sure we get right.
So it's going to be important to take professional advice so that the directors are aware of their filing obligations and their tax liabilities.
Absolutely, yeah. Particularly as the investment classes that you can invest in through a family investment company are very diverse. And we're seeing lots of changes in the market, even with things similar to sort of cryptocurrencies. Different asset classes are taxed on a very different basis, so professional advice should definitely be sought out.
Thanks, Jamie. That's really good to know. So, Sarah, how is a family investment company taxed?
So, as Jamie said, a family investment company is a corporate vehicle, meaning that it's subject to UK corporation tax on its worldwide income and gains. So it's very important that we know, as Jamie said, exactly what the investment and asset classes are so that we know how to tax them. Different asset classes give different income. For example, equities, you'll have dividend income. Bond funds give investment income, which are taxed differently. So it's important that we know exactly what investments are in that family investment company so that we can put that in the tax return. And
it's quite interesting, I find, that certain investments might be taxed in a certain way in an individual's hands, but in a company's hands, they might produce a different result.
Yeah, right? Exactly. Typically around dividends, for example, quite a lot of dividends that a company will receive can be exempted. Some aren't, some are taxed. So it's important that we know exactly where they're coming from. Likewise, interest as well, or it may be called dividends in one account. It's actually more like interest. So key to know exactly what the income is, so we can tax it appropriately.
So once we've ascertained what the taxable profit is for corporation tax purposes, when is the tax due?
So there are a few different dates. Ordinarily for a company, it's due 9 months and 1 day after the year end. So when their accounts are due for filing, that's when they need to pay their tax to HMRC. If the company has made quite large gains in the year on, for example, the sale of equity, or they have very large interest income, for example, their tax payments can be accelerated and brought forward into the quarterly instalment payment regime. So one to keep in mind, if big gains are made in a year or there's a large amount of income, definitely have a word with a professional advisor on whether the tax payments will be accelerated for that period.
And are there any other circumstances when quarterly instalment payments might become in point?
Yes, absolutely. So if a company has a lot of associate companies, so we're looking at 51% connection between companies, then the limits for quarterly instalment payments are halved. So it can bring more companies into the quarterly instalment payment net.
So what is the one thing that you would recommend people really think about when they're setting a family investment company up?
I think for me, just whether it is the correct vehicle and whether it's appropriate for an individual or family circumstances. And to keep in mind, it is a separate legal entity. It is, it's not an extension of someone. It is its own legal entity subject to its own tax regime.
Absolutely, I completely mirror what Sarah says, and I think individuals need to balance the compliance cost and the annual obligations and filing obligations, compliance requirements that they wouldn't otherwise have if they were personally owned.
So thank you, Sarah and Jamie. Really important points to remember there. Well, I hope that you found today's video interesting and useful. If you have any questions at all, then please do reach out to either Jamie, Sarah or myself or your usual Blick Rothenberg contact, and we'd be delighted to help.